Facebook. Okay, so I'm just waiting for some lights to go green, signaling that it's ready. So I'm waiting on one more light to go green. Okay, cool. Right. Good morning, good afternoon, depending on where you are. Welcome to HTJ.tax. This is a podcast or the video if you're watching this on YouTube. What we try to do is have these conversations with thought leaders in an effort to demystify this sometimes confusing world of cross-border tax, international tax compliance. While we may be tax professionals, we are not your tax professionals. So what does that mean? That means that nothing we're saying here should be construed as advice. What we're hoping to do is equip you guys, whether you're watching or listening, with the key ideas or the conceptual tools that you would use to engage your own preferred advisors. So it's not advice, general conversation, general principles. So HTJ.tax, we do these live streams every week. Have a look at HTJ.tax/events. We also publish videos daily on our various platforms. So we have over 1,000 videos, over 1,000 audio clips on interesting key points in international tax. We have over 2,000 articles on our website, all available free of charge. So thank you for joining us. And without further ado, I introduce our two very distinguished guests here to talk about taxes in Canada. Gentlemen, introduce yourselves.
Good morning, everyone. It is morning in Canada. Good afternoon and good evening, wherever you are from. My name is Bala Pudukutai, and I am a partner at CQK LLP Chartered Accountants. In addition to doing the regular audit review and the complete CPA firm services that's being provided, we also provide tax advice, and we focus on tax audit management and also dealing with the Canada Revenue Agencies. So before starting my career as at the firm, I worked with the Canada Revenue Agency both as a tax auditor as well as a appeals officer. So we get involved in a lot of dispute resolutions as well, and able to do some of the administrative practices. That's where we add value to our clients. So that's basically what my background is. And we also focus on sales tax as well, in addition to just corporate income taxes. So Cole, you want to go ahead?
Sure, Bala. Hello, everyone. My name is Makkar, and I'm a CPA and a chartered accountant. I'm based out of Toronto in Canada, and we provide international tax advisory services and as well as transfer pricing. So I'll be glad to answer any questions that you have, and happy to be here this morning at this webcast.
Fantastic. Thank you very much. So I guess we get the best of both worlds, both the private sector client-facing experience, as well as the role of the tax office or the CRA as well. So we get, that varied background coming to bear on these questions. So yes, thank you for those who did submit your questions in advance. We have them here with us. If you still want to ask some questions, if we have time, please feel free to type your questions in the box below and we get to them in the order in which we receive. So the first one is, and I'm going to paraphrase it because it's perhaps a bit too specific and I don't want to be too specific. Okay, so someone is selling a digital product in an online streaming app in Canada. I'll keep it vague so you don't know who it is, because I think it's a very popular platform. Taxes are high in Canada, so I've been thinking about opening an LLC in the US. I was wondering, since I'm selling digital products, how would taxes work? And do I have to charge my customers taxes for buying digital products? I know that's a bit vague, but perhaps we can speak to the issues that are raised. Gentlemen?
Okay. There's a couple of things to consider right here. When we're looking at a non-resident selling products into Canada or providing services, there's two-pronged approach that we do have to take. One is the corporate tax application, where we look at the permanent residence or the permanent establishment to see if they're carrying on business. But when we look at the sales tax, or what we call the value added tax, which is the goods and services tax or the harmonized sales tax, the rules are very different. You may not have a permanent establishment per se in Canada, but because you're soliciting orders and you're selling into Canada, you would have to register for sales tax purposes, which basically leads you to a different situation altogether. So you do not have a permanent establishment. So from a corporate tax standpoint, you don't have to worry about it, or at least initially you don't have to worry about it, depending on how your business grows. But from a sales tax perspective, it is very important that you do have to register for GST or HST purposes. Now they've come up with a lot of new rules, especially with the digital products, and it also depends on the software, the platform, where it is located, and all those things are to be considered. But in a nutshell, or at a very top level, you should consider registering your company for GST and HST purposes. Kul, you want to add something from your
sure, Bala.
perspective too?
Absolutely, yeah, sure, thanks. So yeah, I'll touch it from very briefly from our corporate tax perspective. So as Bala said, you may not have a permanent establishment, but still some of the Canadian tax regulations apply in case you're considered to be doing business in Canada. So doing business in Canada per se is not defined, but CRA has certain criteria. They have, I think, listed 7 or 8 different things. So if you're kind of doing one of those activities in Canada, then you may be deemed to be doing business in Canada. Even if you don't have a permanent establishment, you still may have to register your business number in Canada, and may have to file a tax return. Of course, knowing that under the treaty, you may still not have to pay taxes, but that compliance would be there. So some of the criteria I can read out, the one which is at the top of my mind is that in case you're soliciting clients or business within Canada, even if you don't have a permanent establishment, even if you don't have a physical presence in Canada, so that is considered one. If you're selling your goods and products through any agents in Canada, so that is another thing. So we don't have too much of specific information to your case, but yes, when you're looking at your sales in Canada, you should be aware that there could be your tax filing requirements in Canada and sales tax, as Bala mentioned.
I'd like to add one other thing as well, because depending on where you're selling, we have the goods and services tax, which is the federal tax, and then the harmonized sales tax, because there are provinces like Ontario and New Brunswick, Nova Scotia. These provinces are harmonized sales tax, where you pay tax at a different rate, but they're harmonized with the federal. Then you also have to consider, depending on if you're selling into Alberta, for example, there you'd have only the goods and services tax at 5%. But if you sell in Ontario, you're going to have 13% tax rate. Quebec has its own tax, which is partially harmonized, but still you'd have to file the Quebec sales tax. So what happens is, depending on which province of Canada that you're selling the products to, you would have to register in that province as well for sales tax purposes. Just something to think about.
Thanks a lot for that, gentlemen. So the person who asked the question, if it is you're thinking about leaving Canada and somehow, of course, legally avoiding taxes, I think what the gentlemen have explained is that it may not necessarily be the case that you would avoid. Of course, what you'd want to do perhaps is engage either these professionals or others suitably qualified. And perhaps what you want to do is some sort of analysis that shows, okay, if I do stay in Canada and I continue my activity, this is obviously the steady state. But if I were to move to the US and operate from the US, what would the savings be, considering that you would still have sales tax liabilities and potentially still have corporate tax liabilities, plus you have to deal with the Americans. So as to whether that's a good move, I'd say you probably want to do some deeper analysis. Okay. Thank you very much, gentlemen. Moving on to the next question. And again, if you just joined us, feel free to add your questions by just typing in the box below and we get to them in the order in which they receive. So the second question is, this is a popular question, is, there's a trend towards remote work or becoming a nomad. So if it is that you leave Canada and you go wherever else, under what conditions or under what are the steps to properly sever tax residence with Canada if possible?
It's a loaded question, actually, especially when we're looking at the nomads right now. People working outside of Canada. Now they're actually working outside of Canada, but they're employed by the Canadian company. So all of a sudden you do fall within the employment standards and where the service is being provided along those lines. Now, from what I understand is they are looking into the remote work locations, and they've come up with certain rules, but it's still up in the air. It's a gray area that people are considering what has to be done. But to put it in general perspective, the way for personal taxes or for filing the taxes, either you're a resident, Canadian resident, or a non-resident. If you're a non-resident, then you're going to be taxed only on the services and the earnings that you have in Canada. It's not on the worldwide income, but if you're a resident, then it becomes the worldwide income. One of the thoughts that they are having is saying that the way they want to look at it is based on your residency, because Canada, based on your residency, if you're a Canadian resident, then you'd be paying taxes no matter which part of the world that you're working in. That's one of the things that's coming up. So, Kul, any additional insights into?
Sure, Bala. So I would like to add that there are, again, certain factors which we read as tiebreaker rules. And one of the most important one is the residential status, not the tax residential status, but the other residency. If the person is a permanent resident of Canada or a citizen of Canada, then their income, they have to report a worldwide income in Canada. Yes, there could be some potential areas where a person who wants to see where the tax residency can look at. One of them is has to the CRA is going to evaluate where the person has stronger ties in terms of say banking relationships, in terms of his or her family, in terms of where the employment is. So even if the employment is within Canada, but the person is physically living outside of Canada, purely from a salary earning perspective, we can say that the salary becomes, say the person moves out of Canada to some other location, say in the US, hypothetically. So that person living in the US would get taxed under the treaty. The tax would be in the US, but under the Canadian domestic regulations, the person would get taxed in Canada as well on his or her worldwide income. So you have to be really clear on the ties that you are in a position to break. More specifically, renouncing your Canadian PR or a citizenship, because if your ties are still with Canada, it will be very difficult, because a lot of people actually come with this question, specifically moving to tax-free countries in the Middle East when they moved there. So this question has come up in the past as well, and I would strongly advise that your specific situation has to be looked at and see how connected you are with Canada and how we can, potentially break those ties so that you become a non-resident, a tax non-resident in Canada.
Just to add a couple of things is also that when we're talking about trying to make a clean break is key. So if you have a bank account here, and if you have your family and you have all your community here, then it's kind of difficult to explain that it's going to be a clean break kind of thing. That's one of the things to consider. Now, what some of the employers have also done is within Canada itself, they've limited the employees working out of the province, and that is also for tax purposes, because y- your deductions in the different provinces change at the provincial tax level. So that's one of the reasons. So they will be looking into that very closely.
Thank you for that. So, in other words, it's not really a black and white issue. You need to look at the
Yeah.
specific fact pattern, and basically what you're saying is the more you have, I guess it's almost like a center of life test, like in the European countries. So, the more ties, economic, personal that you have, community that you still maintain with Canada, the greater the chances you'll still be a tax resident. And the more that you can sever and, basically scorched earth, cut everything off and become a bona fide resident of somewhere else,
Right.
then that strengthens the case. And of
Right.
course, if it is that you are one of those perpetual nomads, people keep moving, then you can't be a bona fide resident of anywhere else. So
Right.
therefore, the fallback rule would be you're still Canadian tax resident, potentially.
Potentially. And if you're staying in Canada for over 183 days, then you're deemed to be a Canadian resident anyways.
Okay. All right, great. Thank you. Thank you for that, gentlemen. So that kind of leads us to the next question, and I think you've kind of answered it. So in this case, this person is saying, and it's a quite common scenario, as you guys have already commented. So someone is living and working elsewhere for an employer outside of Canada, but their family still in Canada. They visit them 3 times a year. Are they still tax resident in Canada?
Visiting family is just one of the criteria that they'll be looking at. They'll be looking at the entire facts of the situation. And if you're going to be working outside of Canada and you have a contract for more than 5 years or something, then there could be arguments made to say that, you know what, my only tie is because my wife and kids are home here in Canada. I do come and visit them, but other than that, everything else, I'm generating the revenues outside. So there is a possibility, but again, it's a gray area. Until we look at the detailed facts, we wouldn't be able to answer that. You'd have to consider that too.
Cool. Do you want to comment
Cool.
or add anything?
Yeah, Derren, I think what Bala mentioned is all that I have to say here as well. So there are, number of factors which have to be evaluated. I, in fact, did mention in answering the previous question a couple of them, like, the family or the bank accounts, but there are others as well, like where you have a house, like a property, or where you, have a driver's license, your health card. So, and yes, having an employer outside of Canada definitely shifts the, the pendulum towards slightly towards being considered a non-resident from a tax perspective, but it is not the only criteria. And so I would suggest that it has to be looked more closely for anyone to kind of be able to kind of really answer here.
Okay, perfect. Thank you very much, gentlemen. Next question. So for US expats living in Canada, what W2? So this will be this is as they pay as you earn taxes in the US. So the W2 taxes paid qualifies for the foreign tax credit calculations. So they went on to say federal income tax withheld, Social Security taxes withheld, I know Medicare taxes withheld. In the US, would that qualify for the foreign tax credit calculations on the Canadian returns?
As a matter of fact, yes, it would qualify for it, because what happens is you're filing your US tax filings, and then when we actually file the Canadian taxes right here, we do have to consider the taxes paid, and within that we look at the W2, but what CRA has done right now is they don't there was a time when we would just take the tax return because of the timing of it. We would take the W-2 provided by our clients and we would file the Canadian tax return based on the information on W-2. They come back to us and say, no, we actually want to see the tax return that has been filed to actually know the total amount, the actual tax that has been paid in the US for us to give the foreign tax credit. So it becomes a circular calculation because of the timing of it. So invariably what happens is I tell my clients that you're providing this information, but be informed that 6 months down the road, you're going to get a notice of assessment that is going to change these numbers because of the new information that they will be getting. Okay, cool. Any want to add?
Sure, Vala. I think CRA looks at how the tax term taxes is defined in the US. So the definition does cover, I think, Medicare and that other taxes you mentioned. Sometimes there is, and I have faced that a question in the past as well, where the state taxes, sometimes CRA pushes back, saying that the state tax that you pay would not be given a foreign tax credit because that's not defined within the definition of the taxes, the way these are defined within the treaty. Mostly I have seen that these are accepted for foreign tax credit purposes. But yes, as Bala said, it is not what is there on W-2, it is what you file in your tax return would eventually be considered by CRA.
That is interesting. And the point that Bala that you made earlier, I've seen that as well. We have a few clients that are dual, it's exposed to both jurisdictions, Canada and the US. Yeah. And historically, I mean, it was simple when whoever it is in Canada is doing their returns. But within recent times, like the last couple of years or so, we've seen the CRA push back and they want to see both the original documents, so the W-2 plus the tax return, as you said. So it does seem to be increased vigilance on the part of the CRA. Now, as you mentioned, that the issues at the state level, what about the client, the person who asked the question didn't ask this, but it just triggered my thinking. What about at the provincial level? Do the provinces give tax credits for taxes paid in the US or no foreign tax credits?
To the best of my understanding, I have not seen them giving that credit. Okay. Because now, and one of the reasons that this change has happened is because of data sharing between IRS and CRA. It's got very significant, and now they're also going globally. So I've had clients where they had some interest income and other income from Lloyd's Bank, and they did not report it, and it was caught because of the exchange of information. So the net is big, global.
Absolutely. There's no more hiding. Secrecy is dead. Okay, moving on to the next question posed. For US expats living in Canada, what options are available when the CRA denies the foreign tax credit?
Okay, now the options available is, because one of the things is if they've denied it, we need to understand the basis for it. So that's where we get into, we can file the notice of objection as well for the assessment that you received. And based on that, we had to, the devil is in the detail. So we got to do a lot of digging to make sure and understand the basis why CRA would deny the foreign tax credit and the basis for that. And I've seen a couple of situations where they have denied it, and we were able to turn that around by explaining to CRA the base why the foreign tax credit is it's an entitlement and they should be getting that. Cool. Anything?
No, I think you mentioned it, well, that have to be based on the facts, need to understand. Usually on a more practical scenario, we just reach out to the CRA auditor, try and find out, why they have denied it. Sometimes they just explain it more than what is there on the notice of assessment. And then you can definitely, if you have more documents to support it, you can provide and file a notice of objection. But, I believe that CRA has been, has been receptive on these things, and if the documentation is adequate, I think we should be able to turn it around.
Right. So I guess this is one of the important times when a taxpayer may want to consider getting a qualified tax professional to represent them, because to navigate a situation like this, it could be quite challenging if someone is doing it on their own. Okay, fair enough. Moving on to the next question. And again, if you've just joined us, feel free to type your questions in the box below and we get to them in the order in which they receive. So this is a US tax question. So if US expats living in Canada seeking to become IRS compliant, so for whatever reason you're living in Canada and you haven't been keeping up with your US taxes, generally speaking, there are two programs available. If it is that your non-compliance is deemed to have been non-willful, then there'll be the streamlined compliance procedures. If your non-compliance is deemed to have been willful, you have what was formerly known as voluntary disclosure, or basically referring to the options available in the original IRS manual. So the difference between that concept of willfulness, of course, is not properly really explained in IRS code, but we refer to case law. And case law tells us that something is willful when you intentionally ignore a known legal duty. So you knew that you had to file your taxes and you intentionally did not. Whereas if you're non-willful, then you didn't intend to evade or avoid that known legal responsibility. So since we're getting into the nuances of law, I think the first thing we do when we get clients in that gray area is we reach out to one of the one of the tax lawyers that we work with, because a key part of your submission would be a statement, basically a statement explaining a reasonable cause. As much as possible, of course, you have to understand the facts and circumstances around your case and seeing whether there's a reasonable cause position to be taken, which will hopefully minimize some of the penalties and the interest. On the penalty side, the penalties can be quite aggressive, because the penalties for non-compliance for international tax responsibilities from a US point of view can be not just civil, but criminal as well. So you'd really want to work with a team of both accountants and lawyers to cover both sides of it. So whoever asked this question, please feel free to reach out to us. We are a team of both accountants and lawyers who can help you navigate what could be a tricky and dangerous process if not dealt with properly. So I hope that helps.
So Derren,
Yeah.
Is there a difference between repeat offenders and first-time offenders for non-compliance, or do they look at it on a case-by-case basis?
They look at it on a case-by-case basis. Unfortunately, we have seen people being repeat offenders for streamlined, so they fall behind and then they fall behind again. But their facts and circumstances tend to suggest that they were non-willful. They're just being careless, or life gets the better of them. Family emergencies, COVID, divorce, illness, or whatever. But in terms of those who may be deemed to be willful, those would be rare, because they expense and it is emotional. It is emotional having to go through, because there's a lot of uncertainty with the criminal penalties apply and so on and so forth. In our practice, we have yet to see someone being a repeat offender on the willful side. But so far so good. But after going through that trauma the first time, they learned their lesson.
That's right. Yeah.
Okay. Moving on to the next question. Okay, what's the most tax efficient way to structure the purchase of Canadian real estate if I am not Canadian? I know, again, that's a bit general, but any thoughts?
Okay, if you're not Canadian, and you're purchasing real estate right here, one
Yeah.
of the things is normally what people do is they do set up a Canadian corporation entity so that it's contained within that. And the reason for that is because the moment you're operating some of these real estate transactions, if there is an audit at a later date, your books and records are limited to the company records right here. If you set it up as a branch, or you personally own, or you have a business and you're setting it up as a branch, or the US corporation is purchasing real estate, then you're opening up your US books as well. That's one of the reasons, practical reasons, why people normally would go setting up a corporation right here. And uh, they take the money out as dividends from the corporate, from the Canadian corporation. Cool. Any additional thoughts too?
Not on this one, but just to let the audience know that Canada has actually banned foreigners from buying the property in Canada for the next 2 years
New rules.
because of various factors, inflation and property prices going high out of the roof. Previously as well, and this thing came in at the start of January, I think 4th or 5th of January. That's when they started. But previously as well, there are some additional taxes as well if a non-resident, if a non-Canadian wants to buy a property in Canada. So what Bala said that if they are in a position to set up a corporation and buy it through the corporation, that is still possible, and that will make sense.
Because previously they what they'd done was they, to reduce the foreign investments or foreigners buying in real estate in Canada, they had the additional tax that was applied on the transaction. But even with that, they could not stop the investments. So now they decided to just ban it.
And is there a sense for how long this ban is going to remain in place? Is it a 1 year, 2 years, or they'll kind of wait and see how it goes?
My understanding is 2 years, right, Cole?
2 years, yes. They proposed it for 2 years, unless they extend or reduce it. But for now, it's 2 years.
Yeah.
Okay, so that is interesting to know. But going back to once it's again permitted to do so, in the US, again, typically, I mean, there are exceptions, but one of the key reasons for using a structure to buy real estate would be to limit liability, because the US is quite litigious. And, if the tenant slips and falls, if there's some mishap, the foreign owner could be exposed personally to whatever the liability of the dispute would be. Is that also a common way of thinking through the process? Is Canada litigious as well? Not really. That's not really a concern.
Not the same as the US, though. It's not along the same lines, but still, that is a consideration when they set up the structure.
Right. And also in the US, we also coach our clients on not only being conscious of the income taxes, but also the estate taxes. So we help clients create what we call estate tax blockers, which would, not just help with asset protection, but with probate avoidance or succession planning. Yeah. Is there similar structures and considerations from a Canada point of view? Is there an estate tax to be conscious of?
So what we do is we get into, like both Kulvinder and I, when we're dealing with our clients, we get into proactive tax planning. Compliance is one side of it, but when thinking of the proactive tax planning, then we go generational succession of making sure that the younger generation gets the business assets, as well as the assets of the company, as well as the family wealth is passed on to the next generation. As part of doing that, yes, we do get into the structuring.
Okay,
and,
great.
and look at opportunities to minimize taxes. And we also use some insurance products to make sure that funds are available for them to actually pay the taxes when the time comes.
Understood. That's great.
Okay. There has been, sorry, Derren. Just to add, since it's again, connected to real estate, So there has been, more tightening on this sector, and there has been a vacancy tax which is added again by many municipalities. So if you purchase a house but you are not able to, occupy it or even rent it, then there would be a vacancy tax as well. So any of the investors or audience who want to buy a property in Canada, they should be aware of this as well.
Okay, great. Thanks for that, gentlemen. Next question. What's the most tax efficient way to structure the purchase of Canadian investment property if I am Canadian? So from the inside.
Okay, yeah. Okay. If you're a Canadian, there's two approaches that people do take depending on the amount of the properties. Like if someone is investing in one rental property, two or three, then you're better off going personally, because what happens is in most cases, given the mortgage and the interest rates and the property tax and everything, your net revenue from the rental property would be zero. So you don't have any tax implication. But and it also benefits from getting your bank financing and everything along those lines when you do it as an individual. So for the first few properties, two or three, once clients say that we want to get a lot more and it reaches about 5 or 6 or something, then we say put it through a corporation. It's a real estate corporation. The key thing to remember when we talk about putting money into the real estate corporation and renting investment property through a corporation is that because it's considered passive income, so the tax rates are the corporation is taxed at a higher rate, so the corporation does not benefit with the lower tax rates that normally it would be benefiting by. Okay, so Cole, your insight, please.
Yeah, I mean, from a tax perspective, yes, Bala, that's what it is. So mortgage is an important factor, Derren, and the tax rate, the mortgage, the interest rates offered to individuals are generally lower than what they offer to corporations. So that is one of the factors. Not only from when we have to advise, we look at it from not only purely from a tax perspective, but from other perspectives as well. And as Bala rightly mentioned, if there are 5, 6 properties, then you may want to consider it buying it through the corporation. But if it's 1 or 2, then it'll. So if the person, the capital gains are exempt for one property which the person claims as their personal primary residence. So if if you're buying 1 or 2 and then you are interchanging between a primary residence between one or the other property, so with a corporation, that again would not be there. So our thumb rule would be that if you have number of properties more than 4 or 5, then you may consider buying it through a corporation. But if there are lesser than that, I think you shouldn't really mind about a corporation. Personal under the personal name is a better option there.
There's something else also to consider, because when you're having more than 5 properties, it helps in succession planning when you're putting it to the corporation. That's one thing. And second thing also, from if the property is purchased from a builder, then there is HST or the GST that's applicable on the property, because the builder is selling the property. So there is a rebate mechanism that that can be used. So if you're buying the property for your own purposes, then you get a rebate for it if you're living in there. But also for rental properties, you get a rebate, GST rebate that can be filed for. Now, if that is going to go through a corporation, then you lose out on the rebate. So these are various considerations that people have. So you got to almost look at the cost benefit analysis. Does it make sense?
Absolutely. Thanks a lot for that, gentlemen. Next question. And again, this is a question that perhaps was answered in one of your earlier comments, but still, if I'm a perpetual nomad, i.e. someone who's moving around constantly internationally, but you're also a Canadian citizen, would the CRA still tax me? I think we answered it, but just briefly, gentlemen, if you want to comment briefly, yeah.
If you're a Canadian citizen, then all of a sudden, I think it will be difficult for us to prove that you're filing the tax as a non-resident. So we had to go through the process of the clean break versus. Now, having said that, we do have one client, a very successful gentleman who lives all over the world and pays zero taxes in every part because he makes sure that he's not in any place more than to make him a deemed resident, and he takes all precautions to make sure that there's no connections, and he has bank accounts in tax havens. So it is possible, but it becomes very complex and it's not an easy thing to do.
I also have a client who does that. He moves from country to country, stays in nice hotels because he's done well for himself.
Yeah.
And very, very careful. It is a lot more effort than one would have thought to make sure that you don't trigger rules in any jurisdiction. And then there's another one who lives on a yacht. He's just constantly moving. But so things are interesting lifestyle nonetheless. Anyway, cool. Do you want to make any comments before we move on?
No, I think Bala has covered it well. Yeah.
Okay. If I'm Canadian who's working temporarily in the US, what tax planning should I be doing? That's a very general question, but just general points, gentlemen.
I think we're kind of limited to the best of my knowledge because first of all, you're there temporarily, so you're not having a clean break. So the tax would be filed on being a Canadian resident. Then I'm not sure, like in the US, probably they're filing tax on the earnings in the US, not on the worldwide income because they don't have the green card. So then you make use of the foreign tax credit mechanism and try to minimize the taxes between the two. But I'll ask Kul to add a lot more into this one. So,
Cool. Yeah, in fact, I'd be, I'd be more comfortable if I know what kind of, what source of income are we discussing here? Is it an employment income, business income, or some kind of a passive income? But yes, all that I would want to suggest here is that if it is possible, based on your facts and circumstances, that your income that you earn in the US doesn't come back and get taxed again in Canada at a higher rate. If you can avoid that, that would be, the best thing. Although, again, as we discussed answered in the first question, there are factors and they are not easier to kind of comply with, but the tax planning again, this is definitely a very wide question, and commenting on it may not be possible, but as Bala said, there are a few things that you can do based on whatever we know about this question.
See, what I find is conceptually at a top level, we know the answers from what the tax rules are and conceptually what we can do, what we cannot do. But the devil is in the detail as we keep digging through, and then you go, oh, this doesn't make sense. This is not, it does not qualify, it doesn't meet the condition. That's where I think the facts become very, very critical. So I'm sure you know that too, Derren. That's how it works, right?
Absolutely. The devil is absolutely in the details. So what is the nature of your income? What's the nature of the employment? Or how much time do you need to spend in the US? Maybe you can minimize the time so you don't trigger substantial presence. So you'd only be taxed on the US source income and keep your worldwide income out of the US. Or maybe you do have to spend, by the nature of whatever it is you're doing, you do have to spend the time. In that case, could we take a treaty position? Yep. Or maybe we cannot. And, so again, there are a lot of moving pieces. So I guess whoever asks this question, you probably want to sit with a team of professionals to help you walk through this. But hopefully you get some of the key concepts that you need to keep in mind as you engage your chosen professional. So, okay, moving on. The other way now, if I'm an American who's working temporarily in Canada, what tax planning should I be doing?
Okay, if you're an American, first of all, I'm assuming that you're a non-resident and you're just working here in Canada. So the Canadian taxes it would be only on the earnings right here in Canada, but the US side of it, I guess, would be the worldwide income. So you'd have to consider that. So the same concept would apply again. Cool. Any other additional things that we can think of in that area?
Yeah, well, if we consider that that working means employment, then the employment clause that dependent services clause in the treaty has some relief if you are here for less than 60 days, and the salary income is borne by the employer in the US. Then probably you would be able to avoid the Canadian taxes. But it's not a tax planning that I'm suggesting. It's just what is there under the law. For tax planning, there are limited avenues. I would not suggest you do, registered retirement saving plans that most of the Canadians use, what is called as RRSP, because then there are more issues when you go back to the US, how that would be taxed. If we have more facts and there could be, certain things that can be planned here, but we need more details to be able to answer some, more specifically in this situation.
Mm. Yeah, but generally speaking, for Americans working outside of the US, that is definitely what you just said. That's one of the first things we get into, avoiding investment products in another jurisdiction until you're absolutely sure how it will be treated in both by that jurisdiction and back in the US. Because a lot of things that are tax advantage in another jurisdiction, there'll be tax penalties for it back in the US. I'm speaking specifically about the PFIC designation, the passive foreign investment companies. And it is unfavorable, depending on the situation, can be unfavorable tax treatment of collective investment vehicles or mutual funds unit trusts in other jurisdictions. So something to consider. I want to hop over the next question to another question that was posed that it seems connected to the one that we just discussed. So it's good to do them in tandem. So Aldrin is asking, for US expats living in Canada, are there any reporting requirements for the CRA when the expat has a US LLC back in the US?
Okay, just can you repeat that again? Because I want to make sure that I understand.
Absolutely. So at the bottom of the list, for US expats living in Canada, are there any reporting requirements to the CRA when this US expat in Canada has a US LLC back in the US? He says it's in the startup phase, but he has a company outside of Canada.
Okay. One of the things that's required right now is basically if the Canadian taxpayer has income or assets anything over $100,000 Canadian, they're supposed to be reporting the foreign investments and foreign businesses as well. So that reporting requirement is there. And again, given the data sharing and information, there was a time when it was not enforced that strictly. Now they are actually looking at it. So one of the questions that we do have for most of our, for all our clients is that, do you have any assets that's over $100,000 outside of Canada? If so, we need to get details. This could include having bank balances, investments, and shares in businesses outside. And there are certain exceptions. So we just go through that and say what has to be reported, and that would be reported under what we call the Form 1135. Cool.
Yes, Bala. I would also want to add that since that person owns a LLC in Canada or in the US also is like treated as a disregarded entity, and that adds to complications when how to report that. I'm assuming that the person is a Canadian tax resident. And if that person is, then there could be additional reporting requirement on what is called a Form T1134, where that person has an interest or ownership in a corporation outside of Canada.
Yeah.
So the reason I'm highlighting LLC here is that So whether it will be a T1134 or T1135 would depend on how that disregarded entity LLC is reported in Canada. But there are reporting requirements, and if it is T1134, then it has been since last year the reporting has become very complex and very detailed. Again, I would suggest that if that this person should seek some advice based on how to report that ownership in LLC. It is significant reporting now, and there are penalties attached to it.
So, is it reporting only, or is there potentially tax implications, like taxes may be payable as well?
No, taxes, this T1134 specifically is a reporting return. It's an information return only. Taxes would be, dependent on, again, certain other factors, that if he's, if it is a disregarded entity and that person is a tax resident, whether his global income would be, taxable in Canada. That has to be looked at again. Bala, you wanted to add something? I just realized. Yeah.
So one of the things is the reason that they're enforcing this 1135 reporting of the assets outside the country. There's no tax implication when you report it, but every year you're supposed to be reporting the interest income, the other information that's coming through. Plus, also what happens is if you have, let's say, land, building, and other assets outside Canada, when you dispose that off, there is a capital gain, and they want to make sure that they pick up on that as well. So in year one, you reported you had $1 million in assets outside of Canada, and that asset today in year 5 is worth $5 million. So give us tax on the $4 million. I think it's just the information gathering. It seems like very harmless information gathering to start off with, but there could be implications in the future. So and then they're very strict on, like, if we don't file that form on time, the penalty is very steep, something like $2,500 for not filing it.
Wow. And
so we run into those issues. Sorry, we run into those issues when we have people immigrating into the country and coming into Canada, and they go, we don't have any property. Okay, fine. They walk over. They think that we don't know about it. We just warn them upfront, saying that if you do, this is going to be an implication, because for you to bring money at a later date, you're going to have some issues. So,
right. Are there CFC rules as well, control foreign corp rules?
Sorry? Yeah. Go ahead, Go.
Yes. Yes, there are, and T1134 is actually, to collect information in that direction only.
Yeah.
Okay, understood. Very, very interesting. And then, added to that, I'd throw in, again, we these are the concepts that you'd want to use, Aldrin, when you're engaging with your preferred advisors. But then you'd also want to speak to your advisors as to whether management and control is being exercised from within Canada, or is it that you're just a passive investor and you have there's a CEO, there's everyone doing a thing back in the US, nothing to do, you just collect checks. Then that might be a different situation from if you have operational responsibilities as well. So you may want to have some sort of conversation around that. And when so that has implications as to how the distributions, if any, will be treated, right? Yes. Because if it is you're actively engaged in that distribution, you can treat it as a salary as opposed to dividend. So, it's as Kul was saying at the beginning, it's a pass through. So it is in a sort of gray area, and the facts and circumstances would govern how it's treated. So, okay. Scrolling back up to the last question, which is crypto and NFTs. How does, and again, I know it's a super broad topic, but generally speaking, how does the CRA look at crypto and NFTs?
I think right now, the way they're doing a lot of their own research and trying to see what's the best way to tax it. But I think they're kind of considering that as property, if I'm not mistaken. and saying that this is a property that you own and there's a increase in the value. And if you're disposing that property, then they should be. Now, we're not clear at this point whether they treat it as a capital gain or as a business income or what they're going to be treating it as. So uh, other than in general terms saying that they're looking at it as a property and taxing it on that basis, right? That's what I can comment on. Cool. Any insight on or anything else?
No, well, in fact, I read it some time back, and CRA did mention, as you rightly pointed out, that it will be treated as a property, and has to be reported if there are any gains on that. But I think there is more clarifications. There are more, more details are expected from CRA on this. That's what I think. It's still a lot of non-clarity. In fact, people, some of our clients, they do come to us and ask about how to report that. So we've, that's still a territory which has to be kind of really kind of understood a little more before we can give some comment on that.
Okay, gentlemen, thank you very much. I appreciate you sharing some of your time, your expertise, your insight. If someone wanted to follow up on some of these issues and reach out to you guys directly, what's the best way to reach you? They
can reach me through my email, which is bpudukottai@cqk.ca, or they can, I have clients using WhatsApp and calling me and letting me know, can you set up a meeting as well? So as long as they have the phone number, my phone number, just which I can share with you then afterwards. That's, yeah. And
fantastic.
And cool.
Yeah, I would say the same thing. In fact, I would suggest that if they can reach out to Derren. Derren has all the details about me.
Exactly.
My email and my phone number, and I'll be very happy to answer the questions. And if they need any consultancy, if they need any advice, we'd be happy to provide that as well.
Okay, wonderful. Thank you very much. Have a great day ahead. See you next time.
Thank you so much.
Thank you, Dan.
Derren. Take care.
Thank
Bye.
you.
Thanks,
Bye.
everyone.